Hi there, Jack Foley here from individualtrader.net, and the title of this video is how to combine short-term opportunity with long-term investing. Okay, how to combine short-term opportunity with long-term investing. First off, I want to say that it's rare that you find people basically operating in both sectors of the financial industry. First, you got long-term investing, which is somebody like Warren Buffett, holds stocks for decades on end, reinvests dividends, and basically tries to buy stocks trading underneath their intrinsic value. And he always says that price is secondary. It's all about the asset. That's how Buffett thinks. And if the asset is a very strong asset that spins off huge amounts of cash flows every year, well, then Buffett's intention is to hold that stock forever, and with good reason. Short-term opportunist would be somebody like Paul Tudor Jones. And opportunity can come from anything. Can come from a heightened volatility. As I'm recording this video now, it's the start of March. There's a lot of fears about the coronavirus spreading worldwide. Equity markets have they're down a good 10% in the US. This means the VIX has spiked. And what does that mean? Basically, volatility has spiked, which means that option premium derivatives on stocks are now valued way more expensively than initially before. So the short-term opportunity now from a volatility standpoint would be, especially for premium sellers, would be to sell more of that expensive premium. Traders, short-term traders watching this video would understand that you can basically get further out on your positions, sell out of the money puts or out of the money calls. Also, short-term opportunity could be a binary event such as earnings. Again, that's when volatility would be high. Also could be a technical indicator, something like a volume, maybe an insider buying, I don't know, maybe millions and millions of shares because he has information or she has information that we do not. Stuff like this. This is all short-term movement where you're basically looking for a big explosion in the share price, up or down, and you can take advantage even more so of this by investing in derivatives such as futures or calls or options and the like. So how do we combine the two of these? Well, as I always say to our subscribers, our method is all down to the underlying. And I think that's how wealth is created. It's trading and investing around solid underlyings. What does this mean? It means stocks which have excellent cash flows, growing earnings, a growing dividend, growing sales. It's growing its assets every year. And stocks with low debt, with minimal debt, with very conservative balance sheets. When you invest in stocks like this and you trade around them, then your probability for success increases exponentially. Let me give you an example. Let's just say we do our due diligence on a company and we find a stock trading for $10. Maybe its price to earnings ratio is 5. Maybe its price to book ratio could be 0.8. This means it's trading underneath its book value or underneath its intrinsic value. Maybe its price to sales ratio could be 1, or its price to cash flow ratio could be 5. Maybe it has minimal debt on its balance sheet, could have 90% more equity than debt, for example, and it's growing its earnings. It's expected to grow its earnings next year. Now, straight off the bat, that's a good place to start with in terms of picking the underlying, but that's just one factor of what we do here. So we would, if we held this stock for the long term, we would reinvest the dividends back as we receive them every quarter, back into the underlying every year. But what if we wanted to trade around that underlying? So for example, as I said, the stock is trading at $10. Why not sell? If you didn't have the stock at the time, why not sell a 950 put, maybe a month out, when implied volatility is high, to again decrease your cost basis on that position? Or alternatively, if you're holding the shares, you could sell an out of the money call option. Again, something like a month out, and again, you could sell the 1050, $11 call. Again, this will be priced based on the implied volatility at the time. But again, what you're doing here is you are increasing your income streams on that position. You're already factoring in the dividend. That's number one. Number two is you've bought it cheap, so you're hoping that the valuation will increase over time, especially because you bought it under intrinsic value. That's a second income stream, is just basically the capital gains. And the third income stream, which what we do, is that we like to, trade aggressively around these stocks. Okay, that means selling put options, selling call options, selling option premium aggressively around these positions, especially when implied volatility is high, to continually decrease our cost basis over time. So by continually, if you bought the stock for 10, you reinvest the dividends every quarter, you into buying more shares even, and you reinvest the put premium, the call premium, also could be every month, every quarter, into buying more shares. Our objective is to bring that initial cost basis of $10 per share down to 9, down to 8, down to 7, down to 6. And that's basically the holy grail of investing. So as the stock price is going up, our cost basis is going down. And the end goal is that you want to have that asset free and clear to be spitting off cash flow to you every quarter. That basically is the end goal of what we do here. So if you're interested in this, subscribe to our YouTube channel. You'll see our premium portfolio program there, elevation code, on our blog. And I'll see you in the next video.